Everyone, welcome. I want to welcome you to this webinar we're doing on buy the fear, sell the greed. It's good to see everyone here. It's a Friday afternoon, and I appreciate you attending. If you can do it, I want to do a sound check. You won't be able to see it on your side, but I do want to make sure you're able to hear me. If you could type in a Y or a yes, just want to make sure that everyone is good on their side. So good. We'll get going here. Thank you, everyone. So before we get going, everything that we look at today here is based upon simulated test results. It's not based upon actual trades, and there's no guarantees of future returns. So I'd like to welcome everybody. Today's presentation, what we're going to do is we're going to look at 10 concepts. This was basically a synopsis of what was published in my new book, Buy the Fear, Sell the Greed, 7 Behavioral Quant Strategies for Traders. What we'll do is look at these 12 key concepts from the book, and it's hopefully something that you can learn from. I think for many of you, this will be there'll be information here at least presented in such a way that you've never heard it from me, and it's a way that I've begun going further in my thinking on how markets work, really on a behavioral basis and combined on a quantified basis, putting the two together. And as you see as we'll move ahead over here, pretty much, much of the quantified results that we've seen over the test results that we've seen over the years, we found that there is a fear and greed component to them. And I think this will become pretty apparent by the time we're completed here with today's webinar, which will probably run about 30 minutes, okay? So I started off with this quote intentionally, and this is why I actually opened the book. So the fear is hardwired in humans, and I started with this quote that came from George Patton. And if you take a look at the year General Patton, who was then Major Patton, wrote it, it was in 1926, and I think he probably summarized it best. I read this about 20 years ago, and it resonated with me, and it stayed with me. And basically, he wrote that in war tomorrow, we shall be dealing with men subject to the same emotions as were the soldiers of Alexander. And what Patton was getting at there was that the same emotions felt by soldiers centuries earlier were going to be felt by soldiers in the future, okay? And that goes back to the headline here. Fear is hardwired in humans, okay? This has been proven over and over in many fields. Some of you might be familiar with some of the studies that have been done out there with MRIs. There's many dozens of these scientific studies, and they show this with MRIs, that the brain actually changes when fear is present. So again, fear is hardwired in humans. And this becomes an important point because it's part of the reason that the trading edges and biases you're about to learn exist, okay? So number one here, this is hardwired, and in my opinion, there could be as many machines out there trading the markets. It's not going to change. The machines are still being programmed by humans, and that fear is hardwired in humans. Number two, when you take a look at some of the better trading edges out there, fear is what creates those trading edges. Okay, and this is a way of basically looking at this on an ongoing basis. Then the greater the fear, the greater the edges that occur. And usually what happens here is these edges get created in one of two ways. Number one, it's usually created by current events. And as we're speaking here today, so if you take a look at the behavioral market over the past couple of weeks, it's current events, especially as it relates to trade. So there's a fear in the marketplace, and those the potential trade wars that will potentially come out of that are affecting prices. Okay. But what also gets created is fear gets created when it's associated with upcoming events. So what you'll often see is ahead of a big, whether it's a political event or whether it's an economic event, what will happen is that fear will tend to perk its way up. You'll see that via the VIX, so the VIX will tend to rise. And what happens is that prices will often come in. And this happens in two ways. Number one, the sellers will tend to increase their selling if they're concerned and they're, the more fear that they have in place, they're going to increase their selling. The other part of that is that the buyers who would normally step in, they're going to step aside. If they also have fear, they step aside. And what this does is this leads to short-term mispricing of securities. Okay, this is a repeatable cycle, and you can take advantage of this. Okay, fear comes in, then the event may pass. Ultimately, then prices move higher, and this tends to occur over and over and over again. And you can see this. We've shown this statistically. We've been able to see this now statistically for many, many years, and I'll share some of those statistics with you as we move ahead here. Is everyone good with this? All good with this? If you type, thank you. Okay, so then what we want to do is we have that baseline in place, and we want to look at the types of fear that's out there, and what we're especially focused on, what I especially focus on in the book, and we'll be focusing on an ongoing basis, is the types of fear out there. So as you would expect, the fear of loss in trading is the predominant driver. Okay, so that becomes the fear of losing money. But it's also in the case of money managers of the fear of losing their job. Okay, and this is what drives buying and selling decisions. And this point right here tends to be underestimated, but it's real. Okay, just to give you a little bit of background for those of you who remember what happened back in the late 90s, Jeffrey Vinnick, who was a phenomenal money manager. Okay. Jeffrey Vinnick ran the Fidelity Magellan Fund. Vinnick got bearish on the market early. He saw that there was a bubble that was occurring. He raised cash levels, and Jeffrey Vinnick, who's one of the superstars in the industry, got fired from Fidelity. He ended up losing his job. Okay, he then went on and started his own hedge fund, had tremendous success with it. But with that being said, money managers learned there that if they underperform, and now it's if they underperform the benchmarks, they lose their jobs. And I've worked with other money managers, one in particular who worked for one of the largest mutual funds in the world. And, he spoke about this with me because as we were working together and we were providing some advisory services to them, I mean, that fear of them losing a job is real. That comes into the day-to-day pricing of securities, okay? They need to make sure that they're not underperforming their peers. They need to make sure that they're not underperforming the indexes. Okay. So as individual traders, everybody, this is what markets made about. Everyone is afraid in one way or another of losing money. In the money manager's case, they also fear of losing their jobs. And this is what drives the buying and selling decisions. Okay. So fear of loss, it plays a big role in all parts of life. Okay, it's one of the main drivers in life. It's the loss of money, loss of losing a loved one, loss of love, loss of acceptance. The list is long, and I go as far as that many professionals believe that the single factor that just many people just don't chase their dreams is just for the fear of loss. There's another type of fear, and I sometimes I often smile when I use this as an example because this is real. I've seen this, and I'm sure you've probably seen it also. This the fear of missing out, FOMO. Okay, it drives people crazy when others are making money in the market and they're not. Okay, and there's been studies that have been done that have shown this. So there were studies that were done after 2010. So this is after the market sold off in 2008 and then rallied in 2009, and found that people minded less about losing money in 2008. As long as what they lost was less in line or less than what others lost. Okay. So even though they lost money, they didn't mind it as much if, in fact, they lost less money than others did. I remember going out to dinner with another couple. My wife and I went out with another couple, one of our children's, the parents of one of my children's friends, and this gentleman was a director of one of the major investment firms. We just met for the first time, and this was in early 2009. And I said, "How'd you do last year?" He goes, "We did pretty well. We did pretty well." I said, "Really? What you do?" He goes, "Yeah, we were down 17%." So I'm taken aback that they were down 17%. But in his world, where everyone else was down approximately 35 to 40%. Yeah, they did pretty well. They were down 70%. So again, they didn't mind losing money as long as they didn't lose as much mind as others. Okay. And then there was other studies that were done that found that people who lost less money than others in 2008, but they made less money in 2009, okay, they were angrier than those who lost more money and gained it back in 2009. So at the end of the day, those people had the same amount of money. The net effect was essentially the same. But the ones who underperformed in 2009, even though they basically had the same amount of money, they felt cheated. They felt that they had cheated. They felt cheated, that they had been cheated, that others had larger gains. So that fear of missing out is a big component. There are strategies there. You can see this on a quantified basis, that the fear of missing out creates pricing on at least on a short-term basis that's overpriced, and you can especially see it in bear markets. When the bear market rallies occur and people believe that, or institutions believe that the market's going to run, they'll tend to take things into overbought territory. And historically, those have been good times to be shorting into those times, into those bear markets. Okay. So is everyone good with the first three? You can type in a Y or a yes. All good with that? Fear of loss, fear of missing out. Okay, good. There's an additional piece to this. Not all fear is equal. And what this means is that the behavior associated with fear can be better pinpointed, potentially leading to greater returns based upon the overall market condition. Okay, and this is important to remember. The data proves this out, and pretty much everybody here, I can see everybody, the names of everyone that's here. Pretty much everyone here probably already knows this, okay? Fear in bull markets in equities and in equity ETFs tend to have a much shorter duration than fear in bear markets, okay? So healthy bull markets quickly shrug off fear, and then they push prices higher. And just by simply adding a 200-day simple moving average, 200-day simple moving average, and trading in the direction of the moving average, many times proves this out, okay? And if you take a look at Anthony Robbins' book, which he did on Money Master, it was called Money, and then there was Masters was in the title. One of the people he interviewed in there was Paul Tudor Jones. And Tudor Jones mentioned right in the book, he goes, if I could only use one indicator, it would be the 200-day moving average. What we've seen is that in bull markets, the 200-day moving average, when fear comes into the marketplace, it tends to be muted compared to when markets are below the 200-day moving average. By markets, I mean equity markets and equity ETFs. When they're below the 200-day moving average, fear tends to get exaggerated, tends to be further. So the buying points tend to be, at least on a look-back basis, and this has been true for about a quarter of a century, the buying points above the 200-day moving average when fear comes into the marketplace has been a better place to be than, for example, when fear comes in below the 200-day moving average. Is everyone good with this one? You type in a Y or a yes. All good with that so far? Okay. There's another time period when we're looking at fear. And again, we've been able to quantify this. The behavior of prices leading into the days ahead of a signal play a role. Mounting fear is a lot better for edges to get created than one-day fear. And what I'll do is I'll bring this back in military terms. It's why in the military they'll do multiple days of shelling. Okay, they've known this for many decades. Multiple days of shelling is far more effective than one day of shelling. Humans naturally get worn down from multiple days of pounding. Bringing it back into the trading world on a day-to-day basis in trading, when investors and traders get worn down from losing money over multiple days, they get mentally fatigued and they begin making irrational decisions. And the buyers on the other side often get advantageous prices. They get the average edges in place. So again, when you see multiple days of selling, it tends to be better than that one-day pullback. Okay, and again, that's been statistically seen. Part 3 of this, overnight fear plays a role. So overnight fear leading to prices gapping lower is better than the times that prices don't gap down. And this is especially true after a security has sold off for multiple days. No one likes losing money multiple days in a row and then waking up and find that the stock or ETF gaps even lower. It further increases their losses. What happens is they become more susceptible to selling irrationally at that point, and that's where edges get larger and larger. Okay, and then the final aspect to this, or the additional aspect to all this, and you've probably seen this with some of your own trading strategies and some that you have learned from us along the way. Intraday fear, and even better, intraday panic is one of the best times to buy fear. Investors and traders have less time to rationally react to sell-offs, and they oftentimes panic, especially if that security has been under siege heading into the trading day. You put all these pieces together and you start looking at some pretty healthy edges in the marketplace. Okay, is everyone good with this? Again, I just want to make sure we're all together. If you just type in a Y or a yes, all good? Okay, great. All right, we'll move to number 5 of the 12 that we're going to cover over here. Number 5, this is an important one, and this is one that I have seen play itself out over and over again. And in fact, I would say that this is possibly playing itself out more today than it ever has in the past. And I'll explain it in a couple of seconds, the reason why for this. But people of authority influence large number of traders and investors, and they often create the greatest fear that's out there. Okay. So the media, both the traditional media and social media is a major part of our day-to-day life. And it's a major part of what moves stocks now. And they widely disseminate the opinions of people of authority. And then they oftentimes, in order to create hype, in order to create views on TV, or to be able to create clicks onto the headlines, they'll often tend to overstate what these people of influence said, and sometimes to the point of creating short-term panics. I'm going to show an example of this, but does this make sense to everybody? Does this resonate with you? Can you type in a Y or yes? This resonates? Okay, great. Looks like everybody, that's great. Just about everybody. So this is an example, one of the examples I used in the book. Okay, so this happened a couple of summers ago. This happened in June of 2016. So in June of 2016, you could see this is a chart of SPY. It's well above its 200-day moving average, and you could see basically the market is making a nice quiet market, and as it's heading in towards the end of the month, or it's heading in through the month, it's making all-time high. It's getting close to all-time highs. And, the general feeling back then, I remember the general feeling was that, it's going to be an enjoyable summer here. There's a nice quiet market. It's been trending higher, and this bull market is just going to remain in place. And then what happened is this: Brexit hit. Okay, so you may remember this, but we came into the market that Friday morning, and that was out of nowhere. Brexit hit. UK voted themselves out of the EU, and markets around the world, including the United States, plummeted. It was one-day move to the downside, and this was one of the largest one-day moves in many months to the downside at that period of time. So when you get a pullback like this, using certain type of indicators, depending upon how you're measuring, you may or may not have had a buy signal that gets triggered, but there's a pretty good likelihood that a buy signal was triggered. What you do know is that the world changed from here to here, and the narrative was loud. This is not only narrative in the United States, this is narrative around the globe. Okay, and this is not only narrative in the financial markets; it's narrative in the entire news cycle. Okay, so this is a loud noise, and this is now taking itself into the weekend with this great big sell-off that's occurred. And then what happens? A report comes out. Okay, so there's a gentleman who oversees a phenomenal team of analysts over at JP Morgan, Marco Kalanovic. Okay, so Marco is one of the leading minds out there. His quantitative work him and his team's work is widely respected. Many hedge funds, many large money managers, they really rely on their quant work that's over there. So he's somewhat of a superstar out there, and some people refer to him as a rock star. He carries a lot of weight. Okay, so at the same time that all this happens, he sends out a report that gets widely disseminated throughout the world. And in the report, they basically show that there's $100 billion of equity selling that's likely going to fall in the next few days from systematic strategies that have high derivatives exposure. He also saw a greater chance of a U.S. recession occurring because of Brexit. But this report, I believe, came out after the market closed. So what are people looking at? You're looking at there that there's a potential meltdown in the marketplace. Okay, there's a tremendous amount of short volatility exposure in the marketplace, and that volatility had to get covered. Okay, and that was going to create this trigger effect that was going to, at least in the report, trigger $100 billion of equity selling that's there. And you see something like this, and especially I believe it was the first summer weekend It was the first weekend of the summer in 2016. And at least on the East Coast, for those in the East Coast, you know this, people tend to go away. Most professionals, especially in New York, especially in New York and in Chicago, they tend to go away for the weekend. No one wants to go away in the weekend knowing that they're going to get a hit on Monday morning, okay? And I can only say, the spouses were turning to them and saying, what's wrong with you this weekend? I mean, people really were concerned that there was going to be a meltdown coming into the next week. So this is what you face with because the fear is so great at that given time. If Quantify and his team is right, the market's going to sell off next week. And what's going to happen is if you follow the rules, and I know many of you have been there and seen this, if you follow the rules, you're going to be long and potentially going to be very long in the market. And no matter what, according to the rules, you're taking the other side. And this is the hard part. You're taking the other side of one of the most influential professionals on Wall Street. And this gentleman has a PhD from NYU in theoretical high energy physics, has a team of PhDs who work for him, and he has a track record, a great track record. And not only are you going to be taking the other side of his position, but you're also going to be on the other side of some of the largest trading firms in the world who follow his advice, okay? And this is a real hard place to be, knowing that this is out there. So this is what creates the fear. And as we know, this is what creates the edges that are in place. So Monday morning comes along and it plays out the way Quantify said it was going to do. This report is basically viral. I can remember being on multiple places reading it over the weekend, and then we saw it again on Monday morning. And you could see SPY sells off further. SPY lost on an intraday basis for Monday versus Thursday's close. It lost 5%, approximately a little bit over 5% of its value on where it was on Thursday. There was panic in the marketplace. And again, you're faced with the decision. What are you going to do? Are you going to buy? Because the fear is at the greatest. There's all types of historical edges in place. But again, Brexit looks like it is going to be obviously was affecting markets globally. And you've got one of the best strategists out there that's saying, look, there's going to be a lot of derivative type selling that's going to be coming into the marketplace over the next couple of days. And a systematic quantitative trader with no emotion takes this trade, okay? As individuals, if you're not systematic, if you're not quantitative, there's a decision to make. Do you buy the fear? And this is where fear is at the greatest. This is where the edges are at. Historical edges have been at their highest. What do you follow the herd and take it past? Real easy to take it past and say, I'm going to wait this out. And in some cases, there could be enough of a compelling case if one wants to take a more qualitative approach and make a decision to go short the market at that point, because if that type of selling was going to come in, if that was going to be imminent, you might want to be part of it on the short side. But someone who is buying fear, someone who's taking advantage of historical edges in place, is obviously going to take the trade. And as we all know, no one said that this is going to be easy. Okay. Now let's take a look at what happened, and we see this happen. Has happened just over 90% of the time going back to 1993. It was the bottom. So here was Friday, here was Monday. It all bottomed out, and there's Tuesday and there's Wednesday, and it rallies back up again. Okay, and market ends up becoming slightly overbought. At that point, there's exit signals that are given. And if you take a look at the times when that type of fear has come into the marketplace, and it's come in approximately a little bit over 200 times with a fixed set of rules, over 90% of the time, it's actually, I believe, just over 91% of the time, over a quarter century time, it's correctly predicted the direction of the marketplace. Okay, so this is the reality of buying fear. This is the reality of where edges have historically existed. And one of the things that we want to look for here is going back to over here. People of authority, especially tied in with the way that news is disseminated today, and especially the way social media transmits news and makes it viral real quickly. It plays a major role in these things. And ultimately, you have to ask yourself, am I going to be taking the other side of everyone else? Am I going to be taking advantage of these edges that are in place, or am I going to take a pass? Usually what happens, though, at least historically over 90% of the time, By taking a pass, you end up missing where historically the largest edges have been. Buying with those things in place, with those times in place, have been, where some of the best edges have been, especially in SPY. Is everyone good with number 5? You can type in Y or yes. All right, good. I'm going to go to number 6. So when we looked at the times where markets tended to have the most consistent reversals in prices, so fear in bull markets more often leads to more consistent reversals in prices. So fear in bear markets, and I mentioned this a little bit earlier, is oftentimes justified. Okay, there's usually more when we're talking about bear markets. The 200-day moving average is a good line to be able to use. It basically is the fear when it occurs in bear markets. It's oftentimes justified. That news goes with it. Therefore, it tends to be more volatile to trade, and it's usually as a whole not as profitable as fear in bull markets. So when you see fear in bull markets, it tends to lead to eventually that fear tends to subside faster, and the moves to the upside tend to occur faster. Okay, is everyone good here with number 6? So you want to spend time here on number 7. So I read this a number of years ago. In the book, I give credit to who I read it from. It was from Tom DeMark. Is everyone here familiar with who Tom DeMark is? Can you type in a Y or yes if you know who Tom is? Maybe you've read some of Tom's book. Okay, so Tom DeMark is considered one of the leading technicians and market strategists, and had been for a number of decades. Tom was you can see him in Wikipedia. He's been a strategist and an advisor to a number of the largest hedge funds that are out there, and he really has some great information that's there. For those of you on Bloomberg, we're all able to subscribe to Mark signals. The Bloomberg has added them in as an add-on. But the thing that DeMark said, he wrote this approximately 20 years ago. He said that market bottoms are not put in when buyers come in at the same time. Okay, so the general feeling is like, oh, all the buying's coming in at the same time. That's not true. It basically, as he stated, he said, market bottoms occur when the last sellers sell. And then these people, both professionals and individuals, they can no longer take the pain of losing. And the buyers who were there at that point will gain the advantageous pricing. What happens is those bottoms just don't happen instantaneously and just rise. What happens is the sellers are done selling, okay? And then the buyers slowly but surely come in. It took me many years to understand that and to understand the magnitude of that, okay? And this is where, in looking for the buying pressure, and oftentimes, there's measurements out there looking for buying to come in, that's maybe secondary to the point. That really what you're looking for is you're looking for just the selling to stop. That's when bottoms are made, okay? So again, they're made when the last seller sells, and when those people can no longer take the pain, there's too much fear out there, and they just walk away from their position, so they sell at basically irrational prices, oftentimes at irrational prices. The buyers who were there at that time when they're correct, they're the ones who gain the advantageous pricing. Okay, this makes sense to you? Can you type in a Y or yes? Makes sense. So again, the bottoms are not made when the buyers or all that buying comes in. They're often made when that last seller sells. They can't take the pain anymore. They're all done, and from there, prices tend to stabilize and then oftentimes move higher. Number 8, and we can tie this back to our first slide. Not only is it an inherent human condition, it's a global phenomenon. We've been able to see this and quantify this. In one of the early chapters of the book, we looked at strategy in the global markets. It's accurately predicted the short-term prices of ETFs, equity ETFs, over 80% of the time, and this goes back many, many years. It's further confirmation that fear is an inherent human condition. It's created consistent historical trading edges in markets throughout the world. When we look at this, I sometimes find this I find this somewhat to be fascinating, because people are, from different countries. Obviously, there's different cultures with different behavior, with different ways of doing things, different ways of viewing things. Not making judgment, neither good or bad, or better or worse. It's just they'll look at things differently. But when it comes to fear and greed, it's inherent. And you can see this there on the trading patterns. The trading patterns that work, for example, in the United States, tend to pretty much replicate themselves in most of the markets around the world. The only markets that really you see a little bit of differences, you see the markets that are commodity heavy driven type of markets, it's a little bit less. But when we're taking a look as a whole at markets from around the world, fear tends to be a global phenomenon. So you can apply the same type of concepts here in the US. And when you're taking a look, for example, at country fund ETFs, there's a pretty good probability that those country funds ETFs will show historical edges when fear is at its highest. Okay. And again, this is not by chance. It's because sellers come in, buyers step aside. The event passes or the fear dissipates, the buying reappears. It's a repeatable process. We've been able to see it, especially in the United States for the past quarter of a century. And if you think about it, it's a time where there's been many political, economic, and technological changes. What hasn't changed, and at least in my opinion, never will change, is human emotion. It's inherent. Okay? And this is what we're looking to take advantage of, this repeatable process that comes in place. Okay. So in the U.S., which tends to be where it tends to be most prevalent, you can see from some historical test results, this is one of the strategies that was published in the book. You can see going back from 93 through the end of 2017, 202 signals, and just over 90%. I think earlier I said a little bit over 91%. It was just over 90%, 90.59%. And again, it's just basically waiting for that fear to come into the marketplace. And then, as you can see, approximately 9 out of 10 times, that fear dissipates and prices close higher. Okay. Go to number 9. Does everyone here trade VXX? Type in a wire yes. I think everyone here probably knows what VXX. I see some absolutely. Okay, that's good. A couple of those, but mostly yeses. We've published research on this many years ago. Others have too. VXX is an instrument to trade fear. It was built unintentionally. There was no ill intent when it was originally put together. But when it was built, it was done hastily after the market crashed in 2008. VXX was brought out in 2009. Essentially, was there to supposedly provide protection for people. It's structurally inefficient. 9 years of consecutive losses, of lost money, 9 consecutive years. This is obviously something wrong with it. There are 2 structural aspects of it. No other ETF has this. Okay, so let me talk about these 2 aspects. Okay, number 1, this is well known. There's contango in place, which basically means that it's rolling over and it's buying high and selling low. It's doing this on a continuous basis. Okay, that's the majority of the time. So as it's rolling the VIX futures, it's selling, it's getting rid of the VIX futures and then buying back futures that are priced even higher. And as a whole, that is just a losing game. When contango, it's known as contango. When contango is in place, it's a well-known losing game. But there's another part of this, and I think this is the part that is understated. I go pretty heavily into this part even more in the book. What VXX owns is VIX futures, okay? In VIX futures, the VIX is a form of insurance, okay? And as we all know, insurance is inherently overpriced, okay? Sometimes insurance pays for itself, but as a whole, insurance is inherently overpriced. The VIX is inherently overpriced. It has been since it was first created, and since they first started trading instruments of that. It's a known in the marketplace. So you have 2 parts that are over there. Number 1, you have this built-in contango that occurs as they're selling high and buying low. And number 2, when they're buying that protection, they're buying overpriced protection, which tends to historically erode in price. We've seen various statistics. We've run our own statistics in this. The majority of the time, especially since VXX has come out. In our statistics, what we've seen it as high as 85, 86% of the days that the VIX is overpriced. That is a recipe for something. When you combine these two together, is the reason why VXX has lost 99.9% of its value. If you take a look at UVXY, that is basically that's now the 1.5 time VXX. It used to be 2 time, and they reduced it back in February to 1.5 times. But it's the same type of concept. What they're doing is contango combined with overpriced insurance really creates an instrument that was built to go to zero. So how do you take advantage of that? Number one, any type of short instrument. So for example, with VXX, it always runs the risk that if something occurs that never happened occurred, and VXX runs or there's no protection in place, an account can get hit hard. Okay, all the money can be lost and then some. So learning to basically protect, and one of the best ways to be able to do that from that, especially with any type of short position, is with deep in the money puts. Okay, VXX is liquid deep in the money puts. The market maker, I have various opinions of different market makers depending upon the instrument. The VXX market maker tends to be that group tends to be one of the better groups out there. They look to do business. So VXX usually trades with tight spreads. They have weekly options that are available out there. The market's liquid, and deep in the money puts allows you to basically predetermine what the dollar risk is, and that's the nice part of it. But if you have something here, an instrument that is built to go to zero, and you take a look at it on the charts, you probably have done this on your own. The trend is in your favor. Question is, how do you come in? When is the times to come in? In the book, we show 2 different times, one on a short-term basis and one on a trend-following basis. But as a whole, VXX is really a great instrument to trade fear. It was there intended to provide protection. It was built incorrectly. It's structurally inefficient, and it's there to take advantage of it. So if you're not already trading VXX, maybe something that you may want to add to learning to. If you are trading VXX, there are multiple time frames it could get traded. We show 2 time frames, one on a short-term basis and one on an approximately a 3-month basis. But there are other strategies out there. For those of you who might have been Chairman's Club along the way, there was a day trading strategy that was created a number of years ago. There are multiple ways to be able to take advantage of VXX. Okay, so are we all good with number 9? If you type in a Y or a yes. Okay, great. Number 10, this is really an extension of what I was just saying, that risk management, no matter how good you are in your stock selection, no matter how good you are in your timing, risk management plays a major role in all trading, and especially in this type of trading, because in this type of trading, it tends to be trading when times tend to be more volatile. You want to be able to protect yourself during those times. I was interviewed last night from a group in Australia, and they made it's going to be done on a podcast that will go live on July 8th. But they out of nowhere, the gentleman who interviewed me said to me, goes, did you realize when you wrote short-term trading strategies that work that your chapter stops hurt would have created such a firestorm? So I smiled, and it just amazed me that people still make reference to that. We showed that statistically. It might have been the first ones out there to show statistically that stops as a whole, especially when mean reversion trading, will tend to hurt overall performance. Okay, doesn't mean one shouldn't use stops. Stops do play a role in certain type of strategies, but the main thing is that what stops do is they give a false sense of security. There. Okay, I think people falsely believe that they have a stop in place to protect it, and all it takes is one event for something to occur, and something that occurs overnight. So hypothetically, someone buys a stock at 40 and they're going to risk 10%. They have a stop in at 36. That stock opens up the next day at 20. They're not stopped out at a 10% loss. They got hit with a 50% loss. Okay, so the one of the better ways, in my opinion, to do that is to protect from that is to learn how to trade options. Okay, if they're new to you, start at the beginning. If you understand them, just get better at them. And if you're a professional, go even further, because the number of books and the amount of information that's out there is phenomenal. Options offer you the opportunity to do so many things, including shifting your risk from open-ended risk to fixed risk. And this is an important part of this. Risk is a main staple of successful trading. And options allow you the opportunity to achieve. They also allow you the opportunity to achieve asymmetrical returns at the same time. Okay. And if you take a look at what's available to you, there's now hundreds of different securities that have options with weekly expirations in them. And for those of you who are trading the S&P products, so for example, SPY, you now have expiration 3 times a week, Monday, Wednesday, and Friday. For someone like myself who came into the industry when the options, all they had were, there were only a couple of options out there, and they had quarterly expirations. We had to wait an entire quarter for a new cycle to occur. So when I see something like this, I really greatly, greatly appreciate the fact that now there is expiration on the majority of the liquid securities out there on a weekly basis. And for those of you who are trading SPY, expiration 3 times a week. So this is the golden age for option trading, and it's only going to get better. The markets become more and more liquid. In the right conditions, ask the question, why would someone take open risk in a trading position when they would have the ability to structure trades with a fixed predetermined dollar risk, along with the opportunity to achieve asymmetrical returns. So again, if options are something that you've thought about, think about them as a risk management tool. Think about a way to be able to predetermine your risk ahead of time. These are with long options, and allow yourself to be able to potentially position size better. And if you're correct, potentially be able to make on a risk reward basis, potentially make more money than having the outright instrument itself. Okay. And again, lots of good books out there. Want to go further? There are a number of coaches I see that are online. Some of them are professional traders on the floor. They make the services available. There are large edges in place with the correct construction of options, and it's a great investment. Something that you can use for many years to come. I mean, options are obviously here to stay, and they keep getting more and more liquid. And as you can see, for example, with what the CBOE has done, they've taken the SPY options and made them 3 times a week with those expirations. Okay. Number 11, we all know this, but it bears mentioning again. Quantify as much as possible. I've mentioned along the way that I know traders, they'll instinctively know when there's fear and greed, and especially fear in the marketplace. They can smell it out. A lot of these people tended to acquire, they got their skills by being floor traders, where they instinctively could feel that there was fear coming in. They could see it from the flow of paper coming into the floor, or they were market specialists. But for everyone else, what we want to do is we want to quantify the behavior and the historical edges that have existed. And there's no guarantee that the edges will exist exactly the same in the future. But what we do know is that the edges over many decades were created from fear and greed. And quantifying this allows you to put a disciplined structure in place. Okay. And then we'll wrap up with number 12. Here's the reality of this. And you saw this when I showed the example there from a couple of summers ago. News nearly always precedes these extreme short-term conditions and opportunities, okay? And in fact, having witnessed this for years, I'm really most concerned when these signals trigger and there isn't any news. So when I see, for example, a signal triggering, let's say just by simply using an RSI indicator for a reading, and there's no news accompanying it, I get concerned, okay? I really want to see that this news is there. I've never been, that there's news there. I've never been able to quantify this, but I know that when prices move to extreme without news, it's often not a good sign, and there's potentially something bigger out there. Ideally, what you want is you want a news story to accompany the price, and the bigger the story, the greater the fear and greed, and it's usually the fear, and the greater the edges become. Does this part make sense to everybody? This goes step in step. The news ultimately is what creates the edges, is what creates the fear, it creates the buying opportunity. And ideally, that news creates the buying opportunity. You're able to step in, hopefully take advantage with the position. And then when the fear dissipates, you can sell it to the people who now feel that it's now safe for them to get back in. When it's safe to get back in, prices oftentimes, as you can see, are usually higher, which is a good place to be selling into them. Okay. All right. So quantifying fear and greed, it's a new frontier for traders. It's as far as I'm aware, and in fact, this gentleman in Australia who interviewed me last night said the same thing. It's the first book published that quantifies, at least on a short-term basis, fear, greed. I expect our research, we're going to continue to go further in this field because I believe the opportunities are abundant for traders. And hopefully, I'm hopeful that you've gained new knowledge from this webinar and seen things that maybe allow you to see the markets a little bit, a little bit differently now, and maybe in a better way of basically saying, okay, here's the news, here's the fear that's out there. It's accompanying these readings. This is basically what is creating these edges in place and basically allows you to take these trades. If you'd like to go further with this, you can do so. It's all there in my book, Buy the Fear, Sell the Greed, 7 Behavioral Quant Strategies. You can click there now and all of that. Okay. Has this been helpful? Is everyone good with this? If you type in a wire yes, all good. And I think I see it. Great. Thank you, everyone. Great. Thank you. Right. So I'm going to see if I see a whole bunch of comments that were here, over here. See if there's any questions. Graham, so I'm going to read Graham's question and share this with everyone. And I thought I was going to get asked this. So Graham asked the question: do you have any specific option coaches you recommend? Graham, that's a great question, and I knew when I put this up there, when I wrote this webinar, that this, I thought this question would get asked. I want to give that some time to think about. I personally have access to people who are professional option traders. These are friends. Some have been, some are clients. Some have been, for example, in Chairman's Club. So I've been fortunate to be able to pick their brains and be able to learn my options trading from them. But they don't teach. They're not on the outside, and they're usually, they're trading on the things that they do. I can probably, because I'm probably going to get asked this question again in the future. I should probably create a short list of coaches out there. In the back of the book, I actually have in the book, I have 25 pages of resources and additional information. What I may do is add to the book what coaches are out there, but I really want to make sure that what they're teaching is applicable to what we're doing here, meaning it's consistent, that the thought process is consistent. I also want to make sure that it's just, it's essential with options trading that there's a proper base that's put in place. And if they're jumping ahead, if someone doesn't have the proper base in place and they're talking about Greeks before someone really just has a basic understanding of options, things can get lost. But Graham, I will make an effort in the month of July to go a little bit further in who's out there, and then put those recommendations there. And Graham, if for yourself and for anyone else here, if you want to follow up on that question on coaches, maybe just send me an email at the end of the month of July, and hopefully I'll have that list available for everyone. Okay. So Graham, thanks for asking that. See a whole bunch of comments here. Thank you. That's good. Great. Thank you, everyone. So Casey Warnes, Larry, do you talk about indicators in your book? Yes, Casey, I do. And it's no secret what my favorite indicators are. We still go back. We've looked at lots of indicators, and there's a lot of really good indicators, a lot not so good indicators out there too. But it still goes back to RSI. Still goes back to, at least in my opinion, to be the single best indicator that's out there. If one knows how to use RSI, and that's interspersed with a 2-period RSI, a 4-period RSI, and Connor's RSI. They've all done good jobs on a historical basis of identifying when selling has come into the marketplace, when there's fear in the marketplace. And if I could only choose, Paul Tudor Jones said if you could only choose one indicator, it would be the 200-day. I very much agree with him. I would do a 1A to that. That would be one, and then 1A to that would be having an RSI, having some sort of short-term RSI, and really getting proficient understanding how that RSI works. Okay, and Casey, I do cover that in the book. So thank you for that question. Hopefully that answers your question. Okay, good. You're welcome. A whole bunch of thank you. So you're welcome, everyone. Dan, you have a question last webinar? So Dan asked a question. Larry, last webinar you mentioned starting Chairman's Club again. Dan, what came back is that people came back to me and more requested one-on-one training. So there were greater requests asking for mentoring as opposed to ongoing with the Chairman's Club. So at least for now, I have continued with the mentoring. Whether we bring Chairman's Club back again, it's something that if it's something that I may revisit again. I mean, Chairman's Club really brought a lot of great things. And I think, many of us, many people were part of Chairman's Club felt that way. It may be something that we'll revisit again. And if we do, we'll make an announcement sometime later this year. Okay. So Dan, thank you for that question. Let's see what else. Welcome, Brad, Larry. So Brad asked a question about the average profit. So Brad, when you take a look at the simulated test results, Brad was referring to the one study that I published here in this presentation. The average profit was 1.73%. Brad, that was the average gain. I'm doing this by memory, but I believe that was average gain per trade. Okay, so I believe that combined it. Again, I'm doing this from top of my memory, but I believe it was the average gain per trade. That was there. So that would include the gains and the losses. Okay. Beyond that, I won't have the stats on the top of my head. Those are somewhere. Those are obviously available in our spreadsheets, but I don't keep them open during the presentation. I don't keep them in front of me in a presentation. Okay. Good. You're welcome. Let me just make sure. Other questions. John, how many pages in the book? I believe, John, there's 173 pages, and I will tell you that this book is packed. I believe this is my 7th book outside of the guidebooks that we've written that I've written. It's either my 6th or 7th book. This book is the most condensed, most packed, I should say. It is packed with information. And, I'm a big believer in keeping things compartmentalized, meaning keeping things efficient in writing. I just don't like reading books that are 200, 300, 400 pages long when it can be written, for example, in 50 pages, or 60 pages, or 70 pages. And that's been a policy all the way through with my books. This one is by far the most dense in the amount of information that's there. There's a lot of information in this book. And I can even see it from the feedback coming in from people who got the book, because we released it a couple of weeks ago. People who got the book, I could see from the process of the emails coming in. It's a process. Usually, people in previous books would read it overnight and send me emails. I didn't see that. That didn't happen in this one. The emails were now come in on a little bit longer basis, and that's because there's so much information in this book. So again, it's 175 pages and no wasted space. It was, again, I try to keep these things as condensed as possible. There's a lot of information though in the book. Okay. Again, in this, it's a fairly, brand new topic about, looking at markets on a short-term basis, on a straight, fear and greed basis, and quantifying that. That's new territory that's out there, and it's deep territory, really deep territory. So, John, thank you for that question. Hopefully that answers it. So Paul was asking about VXX models over this past February. So VXX, with any of these things, depending upon how it got traded, VXX obviously was choppy in February. Depending upon which of the strategies, whether it was a short-term strategy or a trend following. Paul, with the VXX strategies, as they're suggested in the book, they're done with deep in the money options. So no matter if someone applied that, it basically, as VXX went through that period, which it does every couple of times a year, those are not going to be winning periods at times. But as you could see, after February passed, or as it began into the beginning of this quarter, VXX went right back. VXX went from above 50 down into the low 30s and just did its game again. Okay, So that's kind of the history of VXX. It goes through these long periods of downtrends and then goes through these short periods of bursts. That's somewhat the history of volatility. VXX just tends to amplify it the way it's built. And so far, so good. We saw no change in the behavior of the models. Well, Paul, thank you for that question. It's a good question. Thank you. All right, good. So Dan, any of the options, so within the book, Dan was asking about the type of options that they're potentially used. So with the options trading, it can be done many different ways. But ultimately, if one is looking to replicate as close as possible the behavior of the underlying security, a deeper in the money option. So that's one with a higher delta. So it's basically moving as close as possible with the security. Tends to be one that, again, if you're looking to move, pretty close to point for point, especially with some of these things that, for example, with VXX, one of the strategies, the average hold is as I mentioned, is approximately 3 months. Ideally, you catch a trend, you want to be ideally be moving on a point for point basis. So that would be done, at least structure can be done with a deep in the money put. And I basically explained how to do that. There's also other ways to be able to do that, to be able to construct those positions, and that's also covered in the book. It's also part of the additional resources. I teach a specific strategy and how to do that. Okay, so Dan, thank you for that. And great, Bill, thank you. Good. Enjoy the book when you order it. That's great. Okay, good. Everybody, are we good? We've just gone 1 hour. Just want to make sure everyone's good. Type in a Y or yes if we're all good. Okay, great. Thank you, Carla. You too. Everyone have a happy 4th of July. For those of you outside the U.S., enjoy the beginnings here of the summer. And I'll probably, along the way, I'm going to touch in with webinars. I'll probably once every couple of months. So everybody will be invited, and feel free to join. So again, thank you everybody for being part of this. I hope you enjoyed it, and I hope you also, if you order the book, hope you enjoy the book. If you have any questions there, you can send them to me. There's actually an email address at the end. You can send me any questions you have when you're done reading the books. Again, thank you. Have a great weekend, and I'll look forward to seeing you again. Take care now. Bye-bye.